There are many ways that you can execute an investment philosophy. In Learning Objective 4, we're looking at ways that you can invest money that you actually don't have for yourself, ways that you can invest more than your current total wealth within your investment strategy. Therefore, we're looking here at describing margin investing and short selling. So margin investing is basically the process by which you borrow to invest. A margin account is a loan type account that you hold with your broker that allows for borrowing to purchase assets. So the margin purchase, for example, might be borrowing money to invest in shares in an equity market. How this will work is that you'll borrow money from the broker to invest, and obviously you'll have to repay that loan eventually, plus both interest and fees and charges that are associated with the margin facility. Now, when it comes to margin investing, the broker is obviously putting themselves at some degree of risk. Their risk is that you might not repay that loan that you have with them. So the broker will seek to protect themselves, and there's different ways by which the broker can protect themselves, but the most important way that they'll do so is by trying to align the investor's interests with their own. So what this will mean is that the broker will often say, well, I'll lend you X amount of dollars to invest, as long as you put up a certain amount of your own capital to also invest within that asset. So that percentage of an investor's own funds, or the investor's own capital that they need to put up, is known as the initial margin requirement. And brokers will stipulate a particular percentage of the overall investor that must be put up at any point in time, and that'll be called the actual margin. So the actual margin at any particular point in time is the ratio or the percentage of the investor's own capital divided by the market value of assets. As we can see on the screen here, this can be calculated as the market value of assets minus the value of the loan. Therefore, in the numerator, we've got the investor's own equity within that investment and dividing by the market value of assets. Now, how a broker will actually use this margin in order to protect themselves against risk is that margin account will be marked to market at the end of each day. Basically, what this means is that as market prices of the equity portfolio change, that actual margin will be recalculated on a daily basis. And what the broker will do is they'll stipulate that if that margin falls between a pre-stipulated value, so that value is known as the maintenance margin, then a margin call will be issued, whereby the investor will be required to top up that account with their own funds. That again is in order to protect the broker's own interests. So it's a way that they're constantly checking on their loan and making sure that that loan does not go near default. Now, when we think about this idea of margin investing, the question is, well, why might someone borrow to invest? Well, the real benefit is that it enables you to magnify potential gains that can actually be made within financial markets. So to give an example here, let's say that there's a security that you bought for $50 and a year later you sold it for $65. Let's say that you used 100 units of your own, you bought 100 units of this particular stock, you bought 100 stocks, and you use your own money to do so, and there were no dividends. So your cash return, or the return that you received, is the closing price was $65, you had 100 stocks, so you sold that investment for $6,500, and you purchased it for $5,000 because you bought 100 stocks at $50 each. So you made $1,500 on your $5,000 investment, or you made a very nice return of 30% on that particular investment. But in this particular case, what would have happened if potentially you invested on margin instead? Okay, let's say that in this particular case, the total cost was still $5,000. So you still bought 100 shares at $50 each. But let's say now that the broker is charging an interest rate of 11% and requires an initial margin of 60%. So that initial margin, they're saying, well, of the $5,000 you're investing, 60% of that has to come from your own money, so $3,000 from your own money. Hence, the broker is willing to lend you $2,000. Okay. What happens in this particular case? Well, we still had the investment portfolio still went from being worth $5,000 to $6,500. So we still made that $1,500 profit that we made before. However, at the end of the year, we have to pay back our interest. We borrowed $2,000 at 11% interest. So that will come out of the cash return that we receive, that interest payment. And the proportion of our own money that we put up in order to make that return, which is $1,280, because we've made $1,500 return less $220 interest. The amount that we actually had to put up to generate that of our own money was only $3,000. So we generated that $1,280 on a $3,000 investment, or our percentage return here was 42.7%. So as opposed to the previous example where we just invested our own cash, here when we invested on margin, we're able to earn a higher percentage return. So that's the main reason why people will consider margin investing. However, it should also be noted that the detriment is that while profits are magnified, so too are losses. So let's now assume that at the end of the period, instead of that stock price going from $50 up to $65, let's assume in fact the terminal value here was only $40. In that case, if we just had invested our own $5,000, our own cash, we would have had a loss of 20%, okay, because the total value of our investment has gone from $5,000 down to $4,000, so a loss of 20%. If we had have taken up the margin option from before, okay, where we borrowed $2,000 to invest, we've still lost $1,000 on our investment because of that decrease in the price. We still have to pay the interest of $220 regardless of whether our asset increases or decreases in value. And remember before that under this margin situation, we'd only put up $3,000 of our own capital. In that particular case, the loss on our capital was 40.7%, so quite a significant loss. So hence buying on margin magnifies both gains and losses. So obviously you'll use margin investing when you've got quite a strong conviction that you've got some investment that's going to rise in value. Now, an alternative way to consider borrowing to invest is not to borrow money in order to invest in the stock market, but you can actually also borrow shares. And this process of borrowing shares is known as short selling. Okay, so short selling, the notion here is basically you're selling something that you yourself don't own. So how can you sell something you don't own? Well, the way this is generally carried out is that we'll have a short seller who will go and borrow the stock from generally a broker. They'll borrow a stock and then they'll on-sell that stock. On-sell the stock that they've borrowed. Now, obviously at some point in time in the future, they're going to have to pay back the broker for that stock they've borrowed. So the short seller will then have to buy back the stock that they've sold and pay that back to the broker. So that's like the repayment of the principal on their loan. Plus, they'll have to pay back a marginal interest rates and fees and so on to facilitate this particular transaction. Now, because of the process of how short selling works, what you're doing is you're selling something that you don't own and buying it back later, or you're effectively selling now, buying later. With a short sale transaction, you will actually profit when the share price decreases, and you will lose when the share price increases. So the reason people use short selling is if they think that there might be a subsequent decline in the value of some asset. That's actually a way that you can profit from that decline. So while the benefits of short selling, again, are relatively clear, it gives you an opportunity in order to benefit from a decrease in the value of some asset, and also short selling sometimes can be used for hedging type purposes. There's also quite a lot of costs. Okay, costs include transaction costs. There's both an initial margin you have to pay, so an upfront fee, plus interest that must be paid back. Because you're borrowing the stock, if a dividend is paid on that stock during the period that you borrow it, you actually have to repay that dividend to the broker as well. That's an additional cost. And also, because when you short sell a stock, we know that you're losing for every dollar the stock increases in value. And a stock has no cap on its potential share price. So a stock could theoretically go up to increase to infinite value, in which case you're making an infinite loss. So losses are theoretically infinite with short selling. Whereas when you invest in the traditional way by buying stocks, losses are capped at 100% because the most that a stock can decrease to is that its value can go to zero, but due to the principles of limited liability, you can't lose any more beyond that amount. So potentially infinite losses is the third cost of short selling. So that's our fourth learning objective. We've looked at margin investing and short selling.